did you guys know that there is a global regulatory body that is governing almost all the banks across the world? They're called the Basel Committee on Banking Standards, or BCBS. With the help to strengthen regulations, supervision, and risk management in banks, it's so important that they were able to step in during the 2008 financial crisis, because after that happened, they set in something new, the Basel III Accord. This was introduced to improve the bank ability to actually absorb shock if there was to be some sort of large financial stress because of global meltdown or something along these lines. There were other added things with transparency and disclosures, but that's all boring banking stuff. What's most important is that banks are being monitored better than ever now, and this is not just in the United States. This is across 27 different countries all across the world. But there are three main principles in the Basel III Accord. 1. Minimal capital requirements. 2. Leverage ratios. And 3. Liquidity requirements. But for this video, we're going to be exclusively focusing on the first principle, which by far is the most important. When it comes to minimum capital requirements, what they're referring to is Tier 1 capital, or CET1. Well, that's a little bit of a lie. It's actually in reference to a capital adequacy ratio. It's calculated by dividing a bank's total capital versus its risk-weighted assets. But you don't have to remember all this. For the most part, let's just simplify it down into Tier 1 capital, as this is by far the largest part of the equation. And it's also the highest quality of regulatory capital that central banks look at whenever they're going to judge risk management from a bank's perspective, like SoFi. But back to the good stuff. As the Basel Committee actually set the minimum requirement for a Tier 1 capital ratio, which was previously, before 2008, at 2%, is now at actually 7%. So much more restrictive whenever it comes to the amount of capital that they have to have on hand. Anything above 7% is considered well capitalized for a bank to be able to handle a large amount of defaults, for example. And due to a lot of bear opinions and low stock prices getting people really concerned, I wanted to share what the central bank thinks of SoFi in general as being risky whenever it comes to defaults coming for their personal loan segment, for example. Because who knows, if our Tier 1 capital is low and the ratio is below that 7%, then we could definitely be at a chance of default here. But whenever you dive into SoFi's financial statement, you can see that their CET1 is a little bit different than you would imagine at 16.4%, much safer than the 7% requirement that would consider us a well-capitalized bank. But that's just a regulatory requirement. I mean, what are we actually doing compared to the competitors to actually see if we're well-capitalized? And just looking here at the biggest banks in America, we can see that we are second place to only TD Bank. Adding these all up, you can see that the average for all of these banks is 11.7% on a CET1 ratio. Even looking at Warren Buffett's golden child fintech, right, Ally Financial, whenever we look at their CET1 ratio, you can see it's only at 9.3%. Now, according to the central banks that actually set this metric, they are still very safe, but comparatively to SoFi, it is much more risky than we actually give them credit for. Now, they're doing this because they want to grow even faster. Now, for the riskier companies, it should be lower because they're trying to take more risks versus a TD Bank or something like this that's so established they don't even need to right now, especially if they're considering a worse time ahead. They're going to be more safe right now if we are in, let's say, a doom and gloom area. Now, I'll give it credit. I'd be lying to say that SoFi's, Tier 1 capital ratio is not going to go down over time, right? This is also because we just more recently became a bank, and so we still have probably a little bit more room to drop down. But whenever you put it into a perspective of a bank that's been there, very much the same size as us, but yet, had the bank charter even longer, you look at Lending Club, for example, they're still at 15.2% on a CET1 ratio. Remember that the ratio being high can actually slow growth going forward, so we don't necessarily want that, as we don't want to be conservative because we're still very much a growth company. This is exactly what Ally Financial understands, because they still want to grow, right? They're still in the growth stages. However, even whenever you compare that to SoFi, right, we're even beating them in that area as well, growing much faster than them. So who knows? I mean, the Bears will be back with more arguments. Don't worry about that. But as long as we keep our capital ratios in good standings, I'm gonna have to trust the 450-member board that are setting the worldwide standard for banking going forward. So just as I was finishing up everything for this video, I just wanted to jump in because Anthony Noto just purchased an additional 1.1 million shares of SoFi over the past 4 days. That accounts for over $5 million worth of SoFi shares that he has just purchased in the last couple days. And some additional clarity as well, that actually increases his total SoFi position by over 25%. But that's his own ownership, not the ownership of the actual company. He actually owns a very small portion of the company. But this is not just chump change for Noto, where he can just run around spending $5 million here and there. If you actually look at Anthony Noto's salary in the past year, it was $1.42 million. Now, this is not including stock options, because why would it, right? Why would anyone actually be, selling their SoFi shares to buy more SoFi shares? It doesn't make any sense. And plus, going through his actual disclosures, he has not been doing that at all. But out of this 1.4 million that he makes every year, he's actually based out in California, which means he pays a 48.4% tax rate, meaning he only really takes home $732,000. So after he pays for all of his daily expenses, then afterwards he can actually accumulate enough to start making SoFi purchases. And obviously he hasn't been waiting like 6 years to make this purchase, only through salary. I mean, he's a wealthy man before SoFi even happened, right? Through Twitter or even Goldman Sachs. But this being said, it's still a massive purchase and a great show of confidence for SoFi. Chris Patel, a noted SoFi bear, said it best on our last SoFi Weekly podcast.
Guy like Anthony Noto, who I'm telling you, this guy is buying a ton of shares. Like CEOs buying shares of their own company is a very healthy sign. That is the biggest form of shareholder alignment that you could possibly get.
So I just thought I'd add this extra insight because this is a massive purchase from Anthony, and I'm so excited to see it. There's also been so many little tiny details that I've been wanting to talk about, which I absolutely put a video out there that kind of conglomerates all those ideas. If you could, like this video though, and subscribe down below if you want to see more financial content just like this. Bye for now.